Welcome. This is Global Signals by Andrew Drummond. We bring you deep dives and insights about retail and FMCG. This chart details the 2026 European FMCG retail landscape. Looking strictly at the sales value column, the economic reality across the EU-5 appears incredibly strong, posting positive percentages. But the physical sales volume column exposes a fractured reality and a sharp split in real demand. Unit volume growth is now concentrated exclusively in markets that brought inflation under tight control. Tracking the health of consumer goods strictly through value sales creates a dangerous illusion. It hides severe supply chain risks creeping into the system. Securing sustainable revenue this year requires us to look past the receipt totals and start analyzing the actual physical units moving through the checkout line. Great Britain is the clearest example. Value sales increased 2.5%, but physical volume contracted by 0.9%. This revenue growth is artificial, resting on a 2.3% inflation rate and a 0.8% buyer population increase. Real unit consumption actually dropped. Specific impulse categories pushed consumers away from making frequent purchases. Non-alcoholic beverages, for instance, saw steep price increases of 4.4%. Despite a seemingly moderate headline inflation rate of 1.3%, the market remains stuck in negative physical volume territory. The household budget imbalance there stems from food inflation remaining stubbornly high at 1.9%, absorbing a majority of grocery budgets. This triggered immediate resistance to discretionary spending, especially when German confectionery prices jumped by 4.7%. German shoppers are not trading down to cheaper private label options. They are simply buying fewer total units and cutting their purchase frequency. Italy faces a state of moderate stagnation. They managed to keep grocery price inflation very low at 0.6%, yet physical volumes still failed to return to positive territory, contracting by 0.3%. Italian retailers had to execute aggressive tactics, cutting healthcare prices by 3.9% just to keep consumers walking into the stores. They also encountered extreme sensitivity to alcohol pricing. A negative 2.62 elasticity rate makes Italy the most price-sensitive beverage market in the EU-5. Across these economies, defensive shoppers are protecting brand loyalty for their daily meals, while severely restricting non-food and impulse spending. Top-line revenue growth in these regions lacks the support of actual consumption. France is the only major European market to successfully execute a deflation playbook, pushing shelf prices into negative territory. By implementing a 0.4% deflation, they created an immediate catalyst for real consumption recovery, leading to a 1.9% increase in physical volume. French retailers executed aggressive price resets on staple goods and non-food categories. Home care shelf prices dropped by 1.9% to successfully drive store footfall. As shelf prices stopped climbing, French consumers returned to buying standard quantities of manufacturer brands, while private label market share stalled. Spain emerged as the top performer across all EU-5 nations, delivering the strongest results in both physical volume at positive 3.3% and total sales value at positive 4.6%. Spain found a sustainable equilibrium between retailer margins and shopper purchasing power by cooling their grocery inflation baseline down to 1.2%. This environment fostered strong brand preference. Spain recorded the highest national brand mix growth in the EU-5 at 1.7%. Spanish households showed low price elasticity in non-discretionary sectors like healthcare, staying fiercely loyal to established manufacturer brands once price hikes moderated. Keeping inflation controlled near the 1% mark restores real consumer purchasing confidence. It defends physical throughput in supply chains without sacrificing top-line revenue. This flowchart details the severe operational risks hiding behind volume contraction. When we compare the outcomes of high inflation in the UK against controlled prices in France, the differences in supply chain survival become clear. The first critical structural problem is plant capacity and factory overhead. The physical volume drops seen in Great Britain and Germany mean manufacturing plants are now running well below their optimal capacity. Fixed operating costs like machinery depreciation, labor, and facility power must now be spread over fewer physical units, which steadily increases the cost of goods sold per piece. The second problem involves transport and logistics inefficiencies. Freight costs do not drop when unit volume falls. Pallets and trucks are forced to move with lower product density, driving up the logistics cost for every single case. Finally, manufacturers and retailers face the margin reset risk. When raw material costs eventually decrease, retailers will demand price cuts. If a category manager has relied solely on price inflation to hit revenue targets without securing unit volume, their top-line sales and profit margins will fall rapidly. Relying on inflation to hit revenue targets is a short-term illusion that breaks the underlying economics of FMCG manufacturing. To navigate the 2026 retail landscape, commercial teams must adjust their category plans immediately to rebuild unit volume. They must stop uniform price increases. Pricing must be differentiated strictly by category elasticity, rather than applying flat hikes to highly sensitive areas like alcohol. Marketing funds should shift from brand building to promotional mechanics, like multi-packs and volume discounts, that physically move cases through the checkout. Teams need to align pricing with the category's role. Use price cuts in non-food and staple goods to defend store traffic, while protecting premium margins in low-elasticity categories like healthcare. It is also crucial to eliminate low-velocity, middle-tier SKUs that add operational complexity without delivering unit volume or brand loyalty. You are watching Global Signals by Andrew Dremin, deep dives and insights about retail and FMCG.